Summary. Many companies have exhibited minuscule growth over the years. However, sometimes minuscule growth is not a reason to avoid them. As long as a company has high profitability, stock repurchases and dividends is what you want to look at. In an age where growth earns top valuation, growth is becoming more expensive, but also risky. As an example, growth darlings such as Nvidia, NASDAQ NVDA, have a trailing PE of 54 and a forward 12-month PE of 47. That's a very rich valuation, folks, for a company that is estimated to grow just 12% in 2018. At least it is in my book. And one reason why many high-growth stocks have been able to get away with such a rich valuation is because this market has not corrected in a long time, and everyone thinks they will make money with NVDA forever. However, risk, meaning capital losses, is always something to think about, even if the market has not corrected in a while. So as opposed to buying a high-growth stock with a lot of risk, investors might want to focus their attention on stocks that have been repurchasing shares, even if some of them have not performed well in the past. There is a lot of criticism for companies that repurchase shares. One argument is, if a company repurchases its shares, then it's not innovating anymore, or enough, and investors need to move on to another stock. I disagree with this thesis. First, there are companies which simply pump out too much cash and don't know what to do with it, even if they have a very big R&D budget. Also, sometimes repurchasing your shares is a better value than buying some other company. When a company produces more cash than it needs, there are several things it can do with it: give it out as a dividend, buy another company, repurchase shares. Assuming a company has no top-line growth, option 1 is the most boring. In many cases, a stock goes nowhere and becomes a sort of bond.